Across the world, something unusual is happening. Billionaires, hedge funds, and even major tech founders are quietly preparing for a recession that economists predict could hit in 2026. The strange part is that most governments are acting like everything is normal. So why are the rich getting ready while everyone else is not? What signals are they seeing? And what could this mean for the rest of us in the next 2 years? To understand why the rich are preparing early, we need to go back to the period right after the pandemic. Most people assumed the world had recovered once factories reopened, travel restarted, and life felt somewhat normal again. But beneath the surface, many problems never fully healed. Supply chains remained fragile, energy prices kept swinging, food inflation rose faster than wages, and interest rates reached levels not seen in more than 40 years. All of this created a slow, quiet pressure on the global economy, building year by year, even though it did not always make the headlines. In 2022 and 2023, central banks around the world raised interest rates aggressively to stop inflation. Rates jumped so fast that borrowing became extremely expensive. That meant higher mortgage payments, higher business loans, and higher credit card debt. Many companies held on, waiting for interest rates to drop again, but the drop never came. Rates stayed high far longer than expected and began pushing companies and governments into dangerous territory. That is because the modern global economy is built on debt. When debt becomes expensive, the entire system becomes unstable. At the same time, government budgets were already stretched. The United States has passed $34 trillion in national debt. Europe faces rising pension costs as their populations age. China struggles with local government borrowing and a weakening real estate market. This combination of slow economic healing, high interest rates, and overwhelming government debt created a foundation that looks steady on the outside but fragile underneath. These issues alone are enough to make economists nervous, but they are not enough to make billionaires panic. Something else is pushing them to prepare specifically for 2026. The first major signal the rich are watching is the bond market. Most people follow the stock market, but wealthy investors watch bonds far more closely because bonds usually give early warnings about recessions. For more than a year, the yield curve has been inverted. This means short-term interest rates are higher than long-term interest rates. It may sound boring, but historically it has been one of the most reliable signs of an upcoming recession. In simple terms, it means investors expect the economy to slow down soon. The longer the inversion lasts, the stronger the signal becomes. The current inversion is one of the longest in history. The second signal comes from corporate earnings. Many companies are reporting weaker profits. Tech companies, shipping firms, and retail chains are lowering their forecasts. Layoffs are happening quietly across industries. You may see news about a few job cuts here and there, but behind closed doors, companies are freezing hiring, cutting budgets, and reducing staff. Some executives are even selling their own shares, which is something wealthy people pay close attention to. When the people running large corporations start preparing for trouble, it usually means they see internal numbers that are not public yet. The third signal is the slowdown in global trade. Shipping demand has fallen. Container prices have dropped. Factories in China, Europe, and the United States are reporting reduced orders. When global trade slows, it usually means consumers are spending less. Lower spending leads to lower profits and eventually to economic contraction. Energy use also provides a clue. When factories and businesses use less electricity and fuel, it usually means they expect lower activity ahead. The fourth signal is trouble in real estate, especially commercial real estate. Office buildings in major cities have extremely high vacancy rates. Remote work has changed how companies use space. Many buildings are worth far less than they were before. This puts pressure on banks that hold commercial loans. If these loans start defaulting, it could spread into the larger financial system. Billionaires know this risk and are avoiding commercial properties. Instead, they are buying farmland, data centers, warehouses, and raw land because these assets hold value even during downturns. When all of these signals line up at the same time, wealthy investors do not ignore them. They act early, not because they are scared, but because they want to be prepared before everyone else realizes something is wrong. But that still does not explain why the focus is specifically on the year 2026. One of the biggest reasons is the global debt wall. Between 2025 and 2026, trillions of dollars in corporate loans must be refinanced. Many companies borrowed money when interest rates were near zero. Now they must renew those loans at much higher interest rates. Some companies will not survive that jump. A large number of defaults can trigger a chain reaction that spreads across the economy. Investors know this and are preparing for that debt wave to hit hardest in late 2025 and early 2026. When governments face budget pressure, they reduce spending, raise taxes, or both. All of these steps slow the economy even more. AI is growing fast and improving productivity, but it is also creating uncertainty. Many companies are preparing to replace jobs with automation. That means millions of workers may face job disruption at the same time that the world enters a recession. Billionaires are preparing early because they expect the job market to experience a shock that many people are not ready for. Many countries have aging populations, fewer young workers, and lower birth rates. This creates a situation where fewer people are working while more people are retiring. That leads to lower economic growth. Some economists expect 2026 to be the year when this demographic shift starts hitting the economy in a noticeable way. So, what exactly are the rich doing right now to prepare for all of this? The first thing they are doing is increasing their cash positions. Hedge funds and private investors are holding the highest levels of cash in more than 20 years. Cash may seem simple, but during a recession it gives power. It lets investors buy assets at cheap prices and protects them from sudden losses. Farmland, rare metals, energy infrastructure, and even water rights are becoming popular. Hard assets hold their value better during downturns because they represent something real and necessary. These investments also act as protection against inflation. A lot of money is leaving startup funds, meme stocks, and risky crypto projects. Investors want safety, not speculation. They are shifting money into stable areas like government bonds, large companies with strong cash flow, and defensive sectors like healthcare and food production. Some are moving assets offshore. Others are investing in countries with stable tax systems and strong energy resources. The goal is simple. If one economy falls, they want to be protected by having assets in other places. But the real question is why the general public is not seeing the same warning signs. One reason is that the stock market still looks strong on the surface. A few big tech companies drive most of the gains, hiding the fact that many smaller companies are struggling. Another reason is that governments avoid talking about recession risks, especially during election cycles. Leaders prefer to focus on positive news rather than long-term threats. People are also tired after years of crisis. Many just want normal life again and avoid thinking about more bad news. And most important, regular citizens receive economic data months after investors do. By the time the signs are clear, the rich are already prepared. So what could actually happen in 2026? One possibility is a mild recession. Growth could slow, unemployment could rise, and markets could drop but eventually recover. Another possibility is a harsher recession. High debt, expensive loans, and a tightening job market could combine into something more painful. There is also a chance of a soft landing, where central banks cut interest rates early, debt pressures ease, and AI improves productivity fast enough to support growth. It is not impossible, but it requires many things to go right at the same time. No matter which scenario happens, the lesson remains the same. The rich prepare early because early action protects them. They look at long-term patterns, not short-term headlines. They adjust before the storm, not after. This does not mean ordinary people should panic. It simply means small steps taken now can reduce stress later. Saving a little more, avoiding unnecessary debt, learning new skills, and paying attention to global signals can make a big difference.